Imagine a future where your money is working for you, even while you sleep. Welcome to the world of investing. But before we dive deeper, let's talk an essential foundational element: financial literacy. Understanding financial concepts and the principles of investment is crucial. It empowers individuals to make well-informed decisions, plan for the future, and navigate the complex world of finance with confidence. This isn't just about making your money grow, it's about setting yourself up for long-term financial security. Whether you're saving for a new car, a dream home, or a comfortable retirement, investing can help you reach your financial goals faster. Now, investing might seem intimidating at first. A lot of jargon, numbers, and charts involved. But don't worry, it doesn't have to be complicated. That's where we come in. We're here to break down essential investment strategies in a way that's clear, engaging, and actionable. We'll explore different investment options such as stocks, bonds, and mutual funds. We'll discuss the potential risks and rewards, and how diversifying your portfolio lead to balanced growth. Ready to unlock your financial potential? Let's dive into the world of investing. First on our list is the vibrant world of stocks, where you become a part owner of a company. Imagine walking into your favorite tech or clothing store, not just as a customer, but as a part owner. That's the beauty of stocks. When you purchase a stock, you're buying a slice of a company, a share of their success, and a ticket to their future growth. Now, the way stocks work is quite fascinating. Companies issue stocks to raise money for various reasons, maybe to expand their business, launch a new product, or simply to pay off debt. As an investor, when you buy these stocks, you're essentially lending them a helping hand, and in return, you get a claim on part of the company's assets and earnings. But here's where it gets interesting. The price of a stock is determined by supply and demand in the stock market. If a company is doing well, more people will want to buy its stock, and this increased demand can drive up the price. On the flip side, if the company isn't faring well, the stock's price can fall. Now, stocks do come with their share of risks. The stock market can be unpredictable, and prices can fluctuate widely in short periods, but they also offer substantial potential rewards. For instance, if you had invested in the stocks of certain tech companies in their early days, your investment could have multiplied several times over by now. Adding stocks to your portfolio can provide the growth necessary to achieve your financial goals. A well-balanced portfolio typically includes a mix of stocks, bonds, and mutual funds, catering to different risk levels and return expectations. Look at Warren Buffett, one of the most successful investors of all time. He started investing in stocks at a young age and built a fortune by buying shares in companies he believed in and holding on to them for the long term. Investing in stocks can be thrilling and rewarding, but remember, it's crucial to do your research before diving in. So keep learning, stay curious, and may your financial journey be an exciting one. Next, let's talk bonds. Your ticket to becoming a lender to the government or a corporation. Bonds, in their simplest form, are loans that you, the investor, give to entities like governments or corporations. In return, these entities promise to pay you back the full loan amount, also known as the principal, at a predetermined date in the future, known as the bond's maturity date. Plus, there's interest involved. You'll receive periodic payments throughout the life of the bond as a reward for your loan. Now you might be wondering, what makes bonds so special? Well, bonds are considered to be safer investments compared to stocks. That's because, in most cases, the issuer is legally obliged to pay back your money. Their safety doesn't mean they're dull, though. Bonds can offer attractive returns, especially if you hold on to them until maturity. Let's illustrate this with a quick example. Suppose you bought a 10-year government bond with a face value of $1,000 and an annual interest rate of 5%. Each year, you'd receive $50 just for holding that bond. And at the end of 10 years, you'd get your $1,000 back. That's a predictable, steady stream of income, isn't it? But how do bonds differ from stocks? Well, when you buy stocks, you're buying a piece of ownership in a company. With bonds, you're not an owner, but a lender. This difference also reflects in how you earn from these investments. Stocks can potentially give you higher returns if the company performs well, but they also carry higher risk. On the flip side, bonds offer lower but more predictable returns. So, where do bonds fit into your investment portfolio? They're the balance to the riskier stocks. By diversifying your investments across stocks and bonds, you can potentially increase your overall returns and reduce the risk of heavy losses. While bonds may not be as glamorous as stocks, their stability and predictable returns make them a vital part of any smart investment strategy. Now, let's explore mutual funds, a basket of investments that offers diversification at your fingertips. A mutual fund is a collection of stocks, bonds, or other securities. Think of it as a basket filled with a variety of fruits, each representing a different type of investment. This assortment allows you to diversify your investment portfolio without buying each individual stock or bond. It's a one-stop shop for diversification, really. One of the primary advantages of mutual funds is that they offer easy access to professionally managed, diversified portfolios. They're managed by financial maestros who use their expertise to pick and choose securities that align with the fund's goals. This can be a great advantage, especially if you're just starting your investment journey and need a bit of guidance. But like anything in life, mutual funds come with their share of risks. The value of a mutual fund depends on the performance of the securities it holds. So if the stocks or bonds within the fund dip, the value of the fund dips too. However, the diversified nature of mutual funds often helps soften the blow of a single stock or bond performing poorly. Let's put this into perspective with a bit of history. Consider the growth of the Vanguard 500 Index Fund, one of the largest and most successful mutual funds. Since its inception in the mid-70s, it has grown consistently, mirroring the performance of the S&P 500. Of course, there have been ups and downs along the way, but over the long haul, it's proven to be a solid investment. Mutual funds can be a simple and effective way to spread your investments across a wide range of assets. Remember, diversification is key to managing risk. So, if you're looking for an investment vehicle that offers a blend of variety, professional management, and potential for growth, mutual funds might just be your ticket to financial success. Armed with knowledge on stocks, bonds, and mutual funds, you're ready to conquer the investment world. As we journey forward, let's take a moment to reflect on the key takeaways from our time together. First, we delved into the world of stocks, where buying shares means owning a piece of a company. It's an exciting venture with potential for high returns, but remember, it also comes with its share of risks. As the company's fortunes rise and fall, so does the value of your investment. Next, we ventured into the realm of bonds, essentially lending money to a company or government for a fixed period. While returns may be lower compared to stocks, bonds provide a steady income stream and are generally considered safer, making them a vital part of any balanced portfolio. Then, we explored the magic of mutual funds, a pool of funds collected from multiple investors to invest in various assets. They offer diversification, professional management, and accessibility, even for those with limited capital. Speaking of diversification, it's a key strategy in managing investment risk. By spreading your investments across different asset classes, you can cushion the blow if one of them underperforms. Remember the old saying, don't put all your eggs in one basket. That's diversification in a nutshell. Risk management doesn't stop there, though. It's essential to do your due diligence before investing. Understand the company or fund you're investing in, its prospects, and the risks involved. Informed decisions are the bedrock of successful investing. Finally, let's not forget the ultimate goal: financial growth. Smart investing can be a powerful tool to grow your wealth over time. The potential returns can be a game changer, setting you on the path to financial freedom. Your journey into the world of investing begins now. Remember, every great investor started somewhere. It's your time to shine, future finance ninja.